Hey guys, how's it going? It's Andy from Magoo Investing. Happy Friday. So I actually decided to take this week off. I went down to Corvallis to celebrate one of my friend's 21ers and just kind of lost track of time. But I'm back and we have definitely had an interesting week so far. The most interesting thing so far has been Trump testing positive. The market opened pretty low this morning and it seems like it's come back a decent amount. So that's going to be something to watch going forward. But in today's video, I'm going to be talking about another article from Motley Fool. And I'm going to be linking this article down below if you'd like to follow along. The title of it is 3 Value Stocks to Buy During a Stock Market Crash. Historically, value stocks have outperformed growth stocks over the very long term. So I'm going to be talking about all 3 of these stocks, kind of give my opinion, give my response to the author Sean Williams' justification for why he likes these 3 stocks. And then I'm going to be going over onto the charts and talking about where, if I was going to be buying into these stocks, where I would be looking to buy in and what I think for the long-term potential of all of these stocks. And so as always, these are only my opinions and you need to do your own research before making any investment decisions. This is not financial advice. Also, if you've been enjoying these videos, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. Also, let me know if there's any specific articles you'd like me to go over in a future episode. So with that out of the way, let's get started and talk about these 3 value stocks to buy during a stock market crash. Before we get into this actual article, I want to say that I kind of disagree on the idea of this whole article just before we get going. When I think about buying value stocks, I want to buy them as the market's about to recover. That's why I've been heavily investing in stuff like Planet Fitness, Southwest. Those are stuff that was crushed during the first crash, and I've been able to really boost my account's profit because they were so undervalued and they've bounced back significantly. If I thought the market was going to be crashing, I would be targeting the blue chip stocks, stuff in my account like Nike and Microsoft, stuff that it's very unlikely that I'd be able to get it at a significant discount unless the overall market crashes. So I disagree. I think if these are value stocks to buy, if you don't think the market's going to crash, but if you do think the market's going to crash, I would be looking at blue chips and not these beaten down stocks already. So just wanted to put that in here before we actually get started and talking about these stocks. So we starts off by saying we've seen a very crazy year so far. Sprinkle in a brief period of negative crude futures and the highest reading for the Volatility Index, which is the VIX, which is a great way to determine the overall volatility of the market. And it's also a good way to determine if option prices are going to be high or low. And so when the market goes down, usually volatility goes up. And it's usually a bad sign if the market goes up and volatility also goes up. That usually means that people are kind of weighing a bunch of different options. But as we go back here, you see in the past 8 bear markets dating back 60 years, there have been a total of 13 corrections ranging between 10 and 19.9% in the 3 years immediately following a bottom. In other words, the average rebound from a bear market low sees an estimated 1 or 2 pretty sizable corrections to the downside, and more often than not, well before the 3-year mark hits. So basically what he's saying is that since we already went into a bear market and it was the shortest bear market in the history of the stock market, there's a good chance that in the past 8 bear markets, there's been 13 corrections between 10 and 19.9%. So what he's saying that there's a good chance that we're going to see another market correction. Technically, we could have seen that if you look at just the NASDAQ falling. But what he's saying is he's looking for value stocks for long-term plays. And so the first stock on this list is going to be CVS Health. The beauty of the healthcare sector is that it's highly defensive. No matter how poorly or well the U.S. economy or stock market is performing, most healthcare stocks are unlikely to see a material change in demand for their products or services. That's why an extensive downside in equities would be a full-fledged opportunity to scoop up shares of pharmacy chain CVS Health on the cheap. The most straightforward reason to own CVS Health is the growing likelihood that an aging U.S. population will become reliant on maintenance therapies over time. You can scoop up CVS Health shares for 8 times forecast earnings in 2020 and you'll receive a 3.5% yield to boot. So let's talk about what I think about CVS Health. I've never actually talked about CVS on this channel. I've talked about one of their main competitors, which is Walgreens Boots Alliance, ticker symbol WBA. Currently, CVS is trading for $58 and it's down 22% in 2020. When I want to talk about their last earnings report, it was actually surprisingly really good. And the main reason behind that is they raised their expectations for their next year earnings forecast. And so we've seen a lot of companies that have come out and have cut guidance going forward because they really don't know what's happening. So anytime you have a company that's raising their forecast for the future, the stock market usually reacts to it pretty well. They talk about how confident the company is at improving during the pandemic and that their diverse businesses are setting themselves up for success. In that last earnings report, they reported a net income of $3 billion, which is up from $1.94 billion for their income a year ago. And the company reported better than expected income from their health care benefits section, that jumped 40% year over year. And so that sounds really good to have their one of their sections jump 40% year over year. But when you look at their revenue sources, it only accounts for around 3% of their overall revenue, whereas pharmacy and retail accounts for 60 and 37%. So 40% increase is nice, but it's also the smallest part of their business. And so recently the company is looking like it's going to recover. However, I have seen some problems when I've talked about Walgreens Boots Alliance, and the thing that really spooks me the most about getting into a stock like this is the fact that Amazon is now a part of this business. And so back in 2019, Amazon bought the company PillPack, which likely, whenever Amazon comes into a new sector, usually the prices are going to go down and it's just going to really cut into your profit margins. And we've seen that already with Walgreens Boots Alliance and CVS. And the fact that 60% of their overall revenue comes from the pharmacy. Yes, they are the US's largest pharmacy chain, but anytime Amazon gets involved, I start to get a little worried. So I'm kind of worried about that for a long-term potential of the company. Going to the charts, I am seeing some interesting levels. Right now, it's kind of in the middle between a nice support and resistance, so I don't think right now is a great opportunity if I did want to get in right now. But when I'm looking at potentially taking a position, I did set an alert for 52.50, which is a recent support, and we did see a nice bounce. So if it comes down to that level, retest it, and bounces to the upside, I might consider making a position. But as of right now, I don't love the long-term potential of the company, just based off of the problems that they've had recently. Amazon's getting involved, and I think there's better options out there. So let me know what you thought about CVS in the comment section down below, and let's get on to stock number 2, which is going to be Western Digital, ticker symbol WDC. Currently it's trading for $36, and it's down a whopping 43% in 2020. So let's see what he has to say about Western Digital. Believe it or not, there is still traditional value that can be found in the technology sector. Assuming you have an investment horizon that's measured in years and not in days or months, data storage solutions company Western Digital could be a perfect value stock. It says recently they've been killed by supply concerns in the near term, but they've also have plenty of growth catalysts on the runway. They're talking about the potential of gaming consoles, and the storage involved with that could see demand pick up. So going forward, we are going to be seeing the next generation of consoles coming out this fall/winter with the PS4 and the new Xbox. And sure, I do think that's a very nice thing to look at for potential growth of the company, but I don't really like the reliance on the success of other companies for you to do really well. That kind of spooks me a little bit. I want the company to be fully in charge of their own products and not have to rely on someone else. But Western Digital's hard drives should remain a key player in data storage centers and representing the future of data storage. So Western Digital shares can be bought right now for roughly 6 times the next year's projected per share profit, according to Wall Street. I don't mind Western Digital. I don't fully understand how the company runs. I don't like the fact that they haven't done very well right now. I understand these supply concerns are definitely a thing. But in their last earnings report, they dropped 12% after it was announced because they had a disappointing forecast. They had nice beats on revenue and earnings, but their forecast for earnings per share is 45 to 65 cents, which is lower than the $1.33 a share that Wall Street actually expected. So for a company that's already pretty beaten down, the fact that their forecast is significantly lower than what Wall Street expected, I don't feel super good for the long-term potential of the company. But for a technical trade, I do think it's actually really interesting. Let me pull that up to BTC. It has been in a downtrend for a bit, but the fact that it's coming up to a very nice support at the $36 mark, or at the $35 mark, is pretty attractive. We've seen some recent bounces back in December of 2018, back in June of 2019, and then it fell through that area during the pandemic. But I always talk about anytime you have a strong catalyst like the pandemic, I don't really consider that when it comes to the charting, just because anything that's going to push it through it, the support wasn't going to hold no matter what. So not really worried about that, but you can go all the way back to May of 2016. So this $35 mark is pretty solid. And so if it comes down there again and bounces, this could be an opportunity for a play. My target would be around the $49, $50 mark. And I'd probably make this a pretty tight stop loss because the company has been in a downtrend for a while, even before the pandemic. But yeah, for a technical trade, 35 to 50 is a very nice profit. and I'll have to see what happens with that. So let me know what you think about Western Digital, ticker symbol WDC, in the comments down below. And then the last stock on this list is going to be Bank of America, ticker symbol BAC. Though the idea of investing in bank stocks may not sound appetizing given the uphill climb of the US economy, value investors would be doing themselves a disservice by overlooking Bank of America. Let's see, Bank of America is also interest sensitive, which means that when interest rates do start rising, Bank of America's interest income would be expected to swell faster than peers. That makes Bank of America a particularly smart buy for a rebounding economy. I've talked about bank stocks a decent amount on this channel. I think all of them are in a decent spot. I think JP Morgan, ticker symbol JPM, is better. And then I think Bank of America is the second best one. And I think Wells Fargo is going to be the third. Personally, I don't think Bank of America is the best option in the sector. They do mention the fact that it is the most reliant on interest rates. And the Federal Reserve has come out and said that they intend to keep interest rates closer to zero for the foreseeable future. So they mentioned that as a nice recovery. If I'm looking at this for a long-term position, sure, that's great. But I do like the potential of JP Morgan based off of their investment banks, which has brought in a significant amount of income for the company. They've also had recent news from the Federal Reserve restricting big banks that have more than $100 billion in assets from share repurchases and dividends for another quarter. And so basically this is to protect the banks from the problems that they had during the last recession. We've seen the stress test, which is something that the Wells Fargo failed because they didn't have enough cash to protect themselves. We've seen a lot of stuff with the banks holding on to extra cash to protect themselves from failed loans and stuff like that. So right now, there's definitely upsides and downsides to bank stocks right now. I do see a nice support at $23 for Bank of America, and I would be interested in potentially getting in at that price, but I do think that JP Morgan is a better long-term investment. I do like the fact that JP Morgan doesn't have to rely as much on the Federal Reserve, similar to what I was saying about Western Digital, having to rely on other companies for success. JP Morgan has been able to do well on their own. Obviously, you have a lot of really horrible news stories coming out of JP Morgan with some of the fraud stuff. But besides that, I think Bank of America is not horrible, and I'm very curious to see what you guys have to say about it in the comment section down below. So let me know what you thought about this list in the comment section down below. I appreciate all the support, and I will see you in the next video.